Welcome to today's video on the hidden dangers of using retirement accounts to fund a business or pay off debt. We will explore why tapping your IRA or taxable investments can be a costly and often irreversible mistake. To set expectations, we'll break down tax rules for taxable accounts, Roth IRAs, and rollovers or traditional IRAs, and we'll illustrate how much money can evaporate immediately due to taxes and penalties. We will also cover a practical action plan, helpful comparisons, and a few quick quizzes to check your understanding. As we begin, remember that taxes and penalties can add up quickly, and the lost compounding can severely impact your long-term security. Now, let's transition into the agenda so you know exactly what's coming. Here is the plan for today. First, we'll clarify why this decision matters so much. Next, we'll cover how taxable accounts trigger capital gains and what that means. Then, we'll walk through Roth IRA rules and distinguish safe contribution withdrawals from risky earnings withdrawals. After that, we'll cover why withdrawing from a rollover or traditional IRA before age 59.5 is often the most expensive route. We'll also illustrate the cost of lost compounding. Then, we'll present a clear action plan if you've already made withdrawals or are considering them. We'll review a real-world case study with round numbers to make the impact concrete. To reinforce learning, we'll include quick quizzes. Finally, we'll wrap up with key takeaways and clear next steps. With that roadmap, let's move into why this topic is so critical. Before we dive in, please note this is general education, not personalized tax, legal, or investment advice. Everyone's situation is unique, especially when joint filing, multiple accounts, or varying income brackets are involved. Consequently, you should consult a certified financial planner or tax professional before acting. With that in mind, let's move into why this decision has such high stakes. This decision matters because early withdrawals from retirement accounts can immediately send a large portion of your money to taxes and penalties. Furthermore, you permanently reduce the pool of assets that could have compounded for years. The combined effect is often underestimated. You not only lose what you pay today, but you also lose future growth. Consequently, a short-term cash fix can undermine long-term financial security. Now, let's transition into how taxable investment accounts are treated when you sell assets to raise cash. In taxable brokerage accounts, when you sell an investment for more than you paid, you may incur capital gains tax. Short-term gains from assets held 1 year or less are taxed at ordinary income rates. Long-term gains from assets held more than a year generally receive preferential tax rates. If you have losses, those can offset gains, which means timing and strategy matters. A simple way to think about it is, gain equals sale price minus cost basis, and the tax you owe is the gain multiplied by the applicable rate. Selling to raise cash may be less damaging than tapping certain retirement accounts, but it can still trigger a tax bill. Next, let's clarify the special rules around Roth IRAs, because not all Roth money is treated the same. With a Roth IRA, there is a crucial distinction between contributions and earnings. You may withdraw your direct contributions at any time, tax and penalty free. However, earnings are different. If you withdraw earnings before meeting qualified distribution rules, such as reaching age 59.5, those earnings are typically taxed as ordinary income and subject to a 10% early withdrawal penalty. Therefore, maintain precise records of your contribution amounts in years to avoid mistakenly pulling out earnings. The safe bucket is direct contributions. The risky bucket is earnings before a qualified distribution. With those rules in place, we should now examine rollover and traditional IRAs, which often carry the harshest consequences for early withdrawals. With rollovers or traditional IRAs, early withdrawals are particularly punishing. Every dollar withdrawn is treated as ordinary income and added to your taxable income for the year. As a result, you can be pushed into a higher tax bracket. On top of that, if you are under 59.5, an additional 10% early withdrawal penalty applies. The combined impact can easily consume 30 to 40% of the distribution immediately. Compounding the problem, you also forfeit the power of future growth on the withdrawn funds. Now that we've covered the rules, let's structure them side by side for quick reference. This table summarizes the landscape. In taxable accounts, selling investments can trigger capital gains. Short-term gains are taxed at ordinary rates, while long-term gains often receive lower rates. In a Roth IRA, direct contributions can be withdrawn tax and penalty free, but withdrawing earnings before a qualified distribution typically results in ordinary income tax plus a 10% penalty. In rollover or traditional IRAs, any withdrawal is treated as ordinary income, and if you are under 59.5, an early withdrawal penalty applies. This quick view helps you see which sources are safer versus riskier. Next, let's visualize how lost compounding magnifies the long-term cost. This timeline contrasts two paths. On the invested path, the original sum continues to compound at a hypothetical rate, growing significantly by ages 45, 55, and 65. On the withdrawn path, the balance for that portion remains at zero because the money was removed, and the investor loses not only the principal but also decades of potential gains. The gap widens dramatically with time, illustrating how the long-term opportunity cost can far exceed the immediate taxes and penalties. With that visual in mind, let's anchor the concepts with a numerical case study. Consider a $50,000 early withdrawal from a rollover IRA at age 40. If your combined marginal tax rate is roughly 30% and the early withdrawal penalty is 10%, your immediate cost approaches 40%, or about $20,000. That means you only net around $30,000 in hand today. More importantly, you have permanently removed $50,000 from your retirement base. If that sum had remained invested and earned 7% annually for 25 years, it could have grown to approximately $271,000. This example demonstrates the double hit: an upfront reduction due to taxes and penalties, and a substantial long-term opportunity cost due to lost compounding. Now, if you're already considering or have made withdrawals, let's move to a concrete action plan. Follow these steps methodically. First, halt any pending traditional or rollover IRA withdrawals until you receive personalized guidance. Second, assemble your paperwork, including any 1099-R forms and recent account statements. Third, consult with a certified financial planner or tax professional to understand your bracket, penalties, and the full implications. Fourth, reassess whether the near-term investment justifies sacrificing long-term security. Fifth, if you decide to proceed, plan for tax withholding, quarterly estimates, and compliance. Sixth, meticulously track your Roth IRA contribution basis so you do not inadvertently withdraw earnings. Seventh, pursue alternatives such as tighter budgeting, side income, partnership financing, small business loans, or grants. Next, let's compare the short-term and long-term trade-offs directly. On the left, early withdrawals can provide immediate liquidity, potentially keep a business afloat, and offer short-term relief. However, they also trigger taxes, penalties, and reporting requirements. On the right, leaving funds invested preserves the power of compounding, can reduce your lifetime tax burden, and helps maintain retirement independence and flexibility. Weighing these factors side by side clarifies that short-term cash often comes at the expense of long-term stability. With that comparison made, let's test your understanding with a quick quiz. Question: which Roth IRA dollars are safe to withdraw at any time without taxes or penalties if you are under age 59.5? Options: A. Earnings only. B. Direct contributions only. C. Conversions only. D. Both earnings and contributions. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is B. Direct contributions only. Roth IRA direct contributions are always accessible, tax and penalty-free. Earnings, by contrast, are typically subject to ordinary income tax and a 10% early withdrawal penalty if withdrawn before a qualified distribution. Now let's continue with another quick knowledge check. Question: withdrawing from a rollover or traditional IRA before 59.5 can immediately cost roughly what portion of the withdrawal? Options: A. 0 to 10%. B. 10 to 20%. C. 30 to 40%. D. Over 60% in every case. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is C. 30 to 40%. Because the full amount is taxed as ordinary income and a 10% early penalty applies, the combined immediate cost can readily reach 30 to 40%, particularly if the extra income pushes you into a higher tax bracket. Now, let's reinforce the most important ideas before we close. Before touching retirement dollars, explore alternatives. First, adjust your budget by cutting non-essential spending and negotiating bills. Second, boost income through side gigs, pre-sales, or strategic partnerships. Third, Evaluate financing options like small business loans, 0% promotional financing when used responsibly, or applicable grants. Fourth, consider asset-based strategies such as selling unused items, leasing equipment instead of buying, or crowdfunding. These paths may preserve your retirement nest egg while still addressing immediate needs. Now, let's capture the most critical points you should remember. Key points to remember. Do not mortgage your retirement unless you face true catastrophe. Selling in taxable accounts can trigger capital gains, so plan carefully. In Roth IRAs, direct contributions are accessible, but earnings are generally taxed and penalized if withdrawn early. With rollovers or traditional IRAs, early withdrawals can cost 30 to 40% immediately. The long-term cost of lost compounding can surpass short-term benefits. Finally, halt any pending withdrawals and seek professional advice, making sure your documentation, including 1099-R forms, is in order. Next, we'll summarize and wrap up with next steps. In summary, early withdrawals might solve today's problem, but often at the expense of tomorrow's security. Understand how taxable accounts, Roth IRAs, and traditional or rollover IRAs are treated so you can avoid avoidable taxes and penalties. Always quantify the true cost, including both immediate losses and long-term compounding you forfeit. Follow a disciplined action plan and consult qualified professionals before proceeding. Explore non-retirement funding options to protect your future. Finally, let's close with a quick, creative call to action. Thank you for watching. If this video helped clarify the risks of using retirement accounts for short-term needs, please like, share, and subscribe. Share your strategies and questions in the comments so others can learn as well. See you in the next video.